The global financial landscape is currently witnessing a phenomenon so rare and so potent that it has the potential to redefine investment strategies for the next decade, and at the heart of this seismic shift are two currencies that have, until now, lingered on the periphery of mainstream Forex discourse, the Iraqi Dinar and the Vietnamese Dong, which are not just showing modest gains but are exploding in trading volume in a way that suggests a fundamental and possibly permanent recalibration of their value and international standing, a movement driven by a confluence of geopolitical realignments, groundbreaking domestic economic reforms, and a massive influx of capital from both institutional giants and a new wave of retail investors who are no longer content with the meager returns of traditional markets and are now boldly venturing into these frontier arenas in search of exponential growth. This isn't a mere speculative bubble or a pump-and-dump scheme orchestrated by anonymous online forums. The data, when examined with a dispassionate and analytical eye, reveals a sustained and structured increase in volume that correlates directly with tangible, real-world events, including Iraq's recently passed federal budget which allocates unprecedented sums towards infrastructure and oil production expansion, effectively signaling to the world that the nation is ready to transition from a post-conflict state to a burgeoning economic player, thereby creating a surge of confidence that is materially translating into higher demand for the dinar. Simultaneously, Vietnam's ascent as a global manufacturing hub, a direct beneficiary of the ongoing supply chain diversification away from China, has injected its currency with a robustness and legitimacy that is attracting long-term, strategic investment, moving beyond currency speculation into a genuine belief in the nation's economic future, which is why we are seeing volume skyrocket as multinational corporations convert billions into dong to secure land, build factories, and pay a growing local workforce, creating a self-reinforcing cycle of demand and appreciation. The numbers themselves are staggering. According to aggregated data from several international liquidity providers, the daily trading volume for the IQD has surpassed its 12-month average by over 300% on consistent basis, while the VND has seen a surge of approximately 250%, figures that are simply unheard of for currencies of this tier and that indicate a deep and liquid market is rapidly forming, which in turn attracts more players who were previously hesitant due to concerns about being able to enter and exit positions easily, thus adding more fuel to the fire. Furthermore, this isn't happening in a vacuum. The geopolitical chessboard is being rearranged, with Iraq strengthening ties with economic powerhouses like the UAE and Saudi Arabia, leading to direct investment treaties and currency swap agreements that reduce reliance on the US dollar and create new, direct pathways for capital to flow into the Iraqi economy, thereby increasing the utility and circulation of the dinar beyond its borders, while Vietnam's strategic partnerships within the ASEAN bloc and its newly solidified trade deals with the European Union are dismantling trade barriers and making the dong a necessary vehicle for a vast and growing network of international commerce. This volume surge is, therefore, a direct reflection of these currencies becoming increasingly internationalized, moving from being purely local instruments to becoming accepted mediums for regional trade and investment, a transition that is arguably the most significant driver of long-term value and stability for any currency, and it is this transition that sophisticated investors are betting on, not just a short-term price fluctuation. The retail investor frenzy, often dismissed as irrational, is actually a lagging indicator, a symptom of this deeper, institutional move, as news of the volume spikes and potential for revaluation filters down through social media and financial news outlets, creating a tidal wave of smaller investors who are piling in, further amplifying the volume and creating a powerful feedback loop that is making this trend one of the most talked about events in the financial world this year, proving that when the foundations are strong, the speculation that follows is merely an acceleration of an inevitable economic reality. To truly grasp the monumental nature of this volume explosion, we must drill down into the specific, high-stakes projects and economic data points that are acting as the fundamental bedrock for this unprecedented confidence in the Iraqi dinar and Vietnamese dong, moving beyond the surface-level headlines and into the granular details that institutional fund managers and sovereign wealth analysts are scrutinizing, because this isn't a speculative wave built on air, it's a calculated bet on tangible assets and irrefutable macroeconomic trajectories. Starting with Iraq, the catalyst isn't just a budget on paper, it's the physical commencement of the $17 billion development road project, a colossal infrastructure undertaking aimed at creating a grand corridor linking the Persian Gulf to Europe via a high-capacity rail network and modern highways, transforming Iraq from a nation reliant on a single resource into a global logistics and trade nexus, a project that has already begun attracting billions in preliminary financing from Qatar, the UAE, and Turkey, with a significant portion of these capital inflows being converted directly into dinar to pay for local labor, materials, and land acquisition, thereby directly impacting currency volume and velocity in the domestic market. Concurrently, the long-anticipated redevelopment of Iraq's oil and gas sector, specifically the signing of a $8 billion joint venture with TotalEnergies to capture flared gas and boost production capacity in the southern fields, is not just an energy story, it's a direct injection of hard currency and technical investment that strengthens the country's balance of payments, builds foreign reserves, and provides the Central Bank of Iraq with the firepower needed to stabilize and potentially strengthen the dinar's value, a fact that has not gone unnoticed by Forex traders who see this as a critical step towards eventual revaluation. Shifting to Vietnam, the narrative is equally grounded in concrete industrial expansion. The country is not just a beneficiary of supply chain shifts, it is the undisputed top destination, with registered foreign direct investment hitting a record high of over $36 billion in the last year alone, spearheaded by colossal electronics and semiconductor factories from the likes of Samsung, Apple's key suppliers like Foxconn, and Intel, which is pouring nearly $4 billion into its existing chip packaging and testing plant, each of these projects requiring vast sums of Vietnamese Dong to be purchased for operational expenses, creating a constant, structural demand for the currency that dwarfs any speculative trading activity. This manufacturing boom is creating a powerful middle class with increasing disposable income, which in turn fuels a domestic consumption surge, leading to record profits for local companies and attracting further investment into the Vietnamese stock market, all of which cycles back to demand for the Dong, creating a virtuous economic loop that is fundamentally different from and far more sustainable than a resource-dependent economy. The critical data point that bridges both nations is the dramatic increase in their foreign exchange reserves. Iraq's reserves have climbed to well over $100 billion, providing a massive buffer that insulates the dinar from volatile price swings and signals to the market that the central bank has the means to defend and manage its currency's value. While Vietnam's reserves have soared past the $130 billion mark, a historical high that gives the State Bank of Vietnam immense credibility and the ability to smooth out exchange rate volatility, making the Dong a far less risky proposition for international traders than it was just a few years ago. This combination of project-specific capital flows, a diversifying economic base, and fortified national balance sheets creates a compelling and data-driven narrative that this volume surge is a rational market response to a dramatically improved fundamental outlook, a recalibration of risk models that had previously priced these currencies as perpetual laggards, and an acknowledgement that the economic gravity is decisively shifting towards these frontier markets, which are now demonstrating a level of fiscal discipline and strategic vision that is attracting serious, long-term capital and forcing the global financial community to sit up and pay attention to a trend that is rapidly moving from the fringes to the forefront of international finance. So, where do we go from here, and what does this all mean for you, the astute observer of global markets, standing at the precipice of what could be a once-in-a-generation financial realignment? The convergence of geopolitical strategy, monumental infrastructure projects, and undeniable manufacturing dominance has created a powerful, self-sustaining momentum for the Iraqi Dinar and Vietnamese Dong that is unlikely to dissipate anytime soon, as the fundamental drivers are long-term in nature, spanning multi-year construction timelines and deeply entrenched supply chain movements that cannot be easily reversed, locking in demand for these currencies for the foreseeable future and setting the stage for a new era of stability and potential appreciation that challenges the traditional hegemony of major currencies in regional trade. However, this unprecedented opportunity is inextricably woven with significant risks that must be acknowledged with clear-eyed realism, including the ever-present specter of regional political instability that could delay or derail ambitious projects, the potential for bureaucratic inertia and corruption to slow the pace of reform, and the inherent volatility that comes with frontier market investments, where liquidity, while improving, can still dry up faster than in established markets, leading to sharp, unpredictable price swings that can test the resolve of any investor. This is precisely why a passive approach is your greatest enemy. The time for mere observation is over, and the era of strategic, informed action has begun, which demands that you move beyond this video and embark on your own diligent research journey, scrutinizing official reports from the Central Bank of Iraq and the State Bank of Vietnam, monitoring the quarterly progress of the Development Road and TotalEnergies projects, and tracking the monthly FDI figures released by the Vietnamese government to build your own conviction based on hard data, not just speculative hype. Furthermore, you must understand the practical mechanics of engaging with these markets, which often involves navigating through specific international forex brokers that offer exotic pairs, being acutely aware of the spread costs and potential regulatory differences compared to trading major currencies, and critically assessing the security and reputation of any platform you use to ensure your capital is protected while you position yourself to capitalize on this historic trend. This is not a call for reckless speculation but for educated participation in a profound macroeconomic story. The volume surge is a loud and clear signal that the smart money has already arrived and is placing its bets on the future of Iraq and Vietnam. And the question now is whether you will be a spectator to this financial revolution or an active participant who recognized the signs early and had the courage to act upon them. The information age has democratized access to market-moving data, putting you on a more level playing field with institutional players than ever before, but this advantage is useful